Okay, we'll start that again. Thanks everyone for being here. Um, Indicators are really something that every trader um, has to find your own space in indicators. Now, I went down a rabbit hole, and I know a lot of folks do in my history, just because I don't use indicators much anymore or don't use a lot of them, so to speak. I use them as reference more than anything, is not because I don't know how to use them. If you take a look at some of my old charts, you can see I overdid the use of indicators. Okay. I know what all of this means. I can tell you exactly what these are for. I can also tell you it didn't help me make any money. And I have tons of these, tons of examples of charts where I overcomplicated everything. Okay, trying to find the perfect chart setup to make me rich, and I spent so much time on this that I literally wasted years in overdoing it in indicators. And if you were around for the Tuesday evening class, I talked about price action. And what I finally learned, for me anyway, is the most important indicator that I was neglecting most of the time. I was trying to use indicators to help me predict something happening in the market rather than just following the price action. And when I eliminated indicators from my chart, everything got easier, because the number one indicator in your arsenal is always going to be price action. It's always going to be the price of the chart. And one of the things that I repeat all the time is we will spend forever and a day trying to create the perfect combination of indicators to test price action and do things in price action, or do things in our trading to improve our trading. And we spend almost no time studying price. And it's price that pays us, not the indicators. An indicator has never paid me anything. Price movement pays me. Okay? So I study price more than anything else, and I use indicators to help me reference those things. So you'll see on my chart here, and by the way, 90% of the time when I'm looking at charts, this is exactly how I look at them. I have volume on the chart just so I can kind of check and see if volume is normal, if it's above or below average. And you can see I've got a 25 moving average laying over volume here. But the honest truth is volume doesn't mean anything to me. As a matter of fact, with the SEC allowing dark pool activity, any volume intraday is useless, because they have that ability to hide all of their activity. And it's the biggest amount of money in the market. The institutions, about 80% of the money out there, we don't get to see what they're doing intraday. They hide it from us. So if you're utilizing volume, all that can really be much used for, I think, in my opinion, is to show you that volume is strong enough to maintain trends, or volume is weakening. That may give you some clues as to what's happening here. I apologize for my voice, guys. I didn't get much sleep last night. I had a rough night last night. I got called away and ended up not getting home until late. But so first off, that's for me, is price is the most important thing. Volume doesn't mean much. Now, I have another indicator down here, and you see it's called balance of power. And really, this is just a throwback to old indicators that I used to use all the time. And I've honestly become so used to it being there that, and it truncates my chart here a little bit, so I'm not spread out from the top and the bottom of the chart, that I leave it there more habit than anything else. Balance of power does have a purpose, and if anyone is interested in that, I can kind of spend some time talking about how balance of power can be useful, but it's not nearly as useful as it was, just simply because of that whole fact that institutions have the ability to hide what they're doing throughout the day. So it's not nearly as effective as it used to be in trading. Now, there are some indicators that I use on TC2000 that I do think are very, very useful in helping you measure or understand the market condition out there. And I know Rick uses a T2123. That doesn't, it's not an indicator that I'm interested in. But if you've ever watched the morning prep videos, T2122 is a very, very important indicator to me. Now, people get confused about these things because one of the things that we do in the world today is if it doesn't provide us immediate gratification, well, it's useless. But remember, I'm talking about market condition. I'm talking about odds, potential odds of trades. So T2122 is really should be very easy to understand. It doesn't tell us which way the market's going to go today or this second. Okay? But what it does tell us, and it tells us very clearly, when we have overextended our market or when we have oversold our market. Okay, so what can you glean from that? And by the way, this is just a 4-week new high, new low ratio. That's all it is. It takes the market, gets a 4-week new high, a 4-week new low, and it tells us when we have extended too far that we're overpriced in the short term. Okay, it tells us when we're underpriced in the short term. This is not meant, I'm using this as a daily chart, so this is more of a swing potential look. You could use this as a longer term and get the same kind of data for it and see the longer and shorter term aspects of it. But the daily is what I'm looking for. I'm looking for those potentials in the market. Now, as you can see, I've got my T2122 set up here. I've got a 90 line and a 100 line, and a 10 line and a 0 line. And all these are really to do is to highlight these ranges where we're starting to reach an overbought area or an oversold area in the market. And you can see I call this the bearish reversal zone, and this the bullish reversal zone in a chart. And what we're looking for is we're looking for those periods of time where the market, that's what it always does. And the market is emotional. And we tend to extend to the upside longer than we should. It's the nature of human beings. We rush in, and it's usually those folks that don't trade much or they trade odd lot trades. They're the last ones to get in the door. They're the last ones to buy. And that means pretty much everybody that's going to get in is in. And that's when things start pulling back. The same thing is true on the downside. Panic sets in, people start selling, we push things lower, and we can also find when we've kind of gone too far and we can expect some kind of a bounce to occur in the market. So think about this, guys. If you're long stocks and we're pushed all the way up here in the bearish reversal zone, it may be time to start moving stop losses up, reducing positions, cleaning up things in your account, capturing those gains, because we're looking for a pullback to occur at any time. It may not be today, it may not be tomorrow, but at any time a pullback is getting ready to occur. And it's just the normal ebb and flow of the market. It's not like this is rocket science. It's just simply giving us that very descriptive look at the market that says these are the likelihoods. And see, if I'm looking at the market condition and I'm not looking for the direction in the trade, because remember, the direction of the trade is going to be price action for me. I'm looking for the market conditions that tell me I need to be watching for the pullback, collecting profits on my long trades, and then those charts that are setting up in short patterns, maybe looking for short trades. When we push all the way down here, I want to start cleaning up my short trade positions. I closed out the last of my diamonds credit spreads trade the other day because we were pushing down here to the lows. Closed it out, collected my profits on the trade. And yesterday I said I was kind of considering some bullish trades, but decided to wait with the data that we had coming. And that's proved to be okay. And not that today is bad, it's just that we're kind of pushing back down. I think the diamonds may seek its 50-day moving average just to give it a test like all the other indexes have. So what I'm going to be watching is and expecting is a relief rally to begin at any time. Okay, so this gives me that confidence to start looking at good, strong charts that may be setting up for long trades, and I'm waiting for those entries to occur that they could be coming. I'm setting price alerts, waiting for those entries to occur so that I could take advantage of that relief rally in the market. And T2122 gives me that great basis point of where we are in the market condition, not an individual trade, but in the market condition. How should I be positioning myself in the overall market? I go a little bit deeper here with T2108. And by the way, if somebody asks this every once in a while, where can I get this indicator, or can I get this indicator on Thinkorswim or any other platform? And to my knowledge, it's nowhere else but TC2000. I have looked, I can't find it in other places. So I've been using this for so long, I don't know what I would do without it. And if you don't have those, obviously you can watch the morning prep videos and get some information from those, because I cover this every day. It's my prep to prepare me for the market condition, to remove emotion and prepare me for the market condition. T2108 is the percentage of stocks above the 40-day moving average. Now that's not all that hard to figure out, right? How many stocks are holding above the 40-day? How many stocks are falling below the 40-day? And it gives me that in a percentage. Now, think about that. If it were me and if I were designing this tool now, it would be the 50-day moving average, because I don't know anybody that watches a 40-day moving average. The 50-day moving average, I think, would be probably more to the liking of most traders. Okay. But when you look at T2108, it's telling us the strength of the market. If we start seeing stocks pulling back and we're failing and falling in the internals, even if, like this morning, we had the Dow pushing to the upside, T2108 never turned to the upside. That's a clue. That's a clue that we may not have enough momentum or energy to push on through to the upside. So T2108 shows me that strength of the internals of the market, saying, or weakness in what's going on here. And support and resistance work exactly the same way here. Okay. All right. So when you look right across in here, we had a support level. You can see all the spikes up in there along that line. and we failed. We can see trends. When the trends break and fail, we can see that in this chart that there's a weakening occurring. You can also see bigger trends. When we push T2108 up here into these 70 areas, it's a very rare occurrence we can stay there. Very rare. We're almost always going to be looking for a market pullback when that occurs. So I can be prepared for that. Not over trading long, tightening stops, taking long positions off, expecting the pullback to occur. Same thing is true here in T2108. If we push down in here these extraordinary lows, you can't maintain that for very long. Okay, and then we start the relief rally, the bounce back to the upside. So can you guys see how this is really important to me on my timing, on how I approach the market? I approach the market with the attitude we're overbought or we're oversold, and I'm looking at it through that lens so that I'm not over trading to one side or another. It's preparing that market condition. If I take a look at T2107, that goes one step further, percentage of stocks above the 200-day moving average. And it also gives me that indication showing where we've broken support levels, we've broken trends, that weakness coming in here. And T2107, we start reaching up here into these upper 60s. We usually can't sustain that very long. Start looking for those failures to begin to occur in the market. And that's just the normal ebb and flow in the market. We have people that run into the market and everybody follows, and we go and we go and we go, and then all of a sudden that starts to slow down because everybody who's in that trade is already in. No one wants to chase it any further to the upside, and markets will only allow those stocks to stay there for so long. And then you have an opportunity loss. And so it starts pulling back and softening, and then people start selling and taking profits, and we get the pullback that occurs in the market. So it's just that normal ebb and flow. And this gives me great information on that condition of the market. And one other that I really, really like is the T2101. Now, T2101 is the absolute market breadth of the market. It's showing us essentially momentum. Okay, and when we were kind of stringing along, going up, and just barely moving, you guys notice that like last week, all of a sudden it just became really hard to make money to the upside because we just didn't have any momentum. We get buy signals, but nothing would follow through. Well, T2101 was telling us why. We were running out of that upside momentum. We were drifting. We continued to drift down, and it lingered down here with very low momentum. There was no enthusiasm to buy. Well, what happened here the last couple of days is all of a sudden market breadth has come up, but it's on the sell wave. Okay. So the sellers are in control right now, and we know that. But this can also give us clues when that starts to wane, when that starts to run out of energy. And one of the reasons I didn't do long positions for today is T2101 yesterday was still going up at the close. It hadn't started to even turn or hook over. We hadn't lost the sell side momentum yet, and we're continuing to extend up in here, and this will also develop trends. You can see, give you indications on things here in the market that can give you that internal of the condition. If this starts to hook over today, I'll be much more inclined to be looking for that relief rally on Friday. Okay, looking for that oversold condition to start to relieve itself, push back up. We'll shake out anybody that's short. When we start to bounce, they'll start to cover those positions. The market then rallies. Okay, is this making some sense, guys? Hopefully this is helpful. And then, of course, you guys know if you watch the morning preps, I look at the VIX. And the VIX is just like any other indicator out there. It's looking for fear and greed. That's all it is. It's looking for fear and greed. And it helps me in gauging the sentiment of the market. Okay. And I've been mentioning this recently as we were pushing down. I said, as long as we continue to follow the downtrend here in the chart, no worries, uptrend can continue. When we break that downtrend and then we hold the higher low, just like every pattern that I talk about in the market, this is where real fear begins to come in, where real selling begins to come in. And that gave me confidence to hold those short trades for the market because that sentiment was shifting here. And we can see now that we have the first evidence, the very first evidence in the VIX of a possible uptrend. Okay, now this uptrend will only confirm itself as if that fear takes out this top here. We're stretching up there. I think we maybe technically ticked up through there. And then we'll start thinking about, well, what's the reaction then? The reaction from that period of time might be a consolidation or a pullback to come back to test trend. And if we hold the higher low, then we look for more fear to come into the market. It follows trends just like everything else. Okay, so those are indicators that help me with that market condition. Indicators that help me identify trends and trades are just your standard, very simple indicators that I use. I use this chart, I label it as the T-line chart. And it helps me identify those patterns in any chart, okay, where we are around our moving averages. Now, there are specific moving averages that pretty much everybody in the market watches, and that's the 50-day and the 200-day. There's a lot of folks that use a 20-day. There's a lot of folks that use a 30-day. But the 50 and 200 are pretty much standard. You can probably go to anybody that runs a chart or trades from a chart. They're going to have a 50 and a 200-day simple moving average on their charts. And the reason those are effective is because so many people look at them. Okay, I made mention of this morning in the morning prep. When you start getting this close to a 50-day moving average, the 50-day moving average starts to act as like a magnet. It pulls, and you think about that, it's kind of logical. It's psychological for sure that we would look for that 50-day moving average to provide us support, and there's price support in this chart to boot. So you could see that possibility. If we don't get down there today, then we still have that possibility, depending on how data comes out, that we dip in there and we test that 50. And here's the thing, even if we rally from here, even if we bounce from here, we'll typically see a bounce that goes back, tests a resistance level, tests a downtrend in the chart, and then we still come back and we catch that 50-day moving average. It's normal. We do it all the time. Look right over here. Test it, test it. Break through it, test it. And I think the only reason that's the case is so many people watch those moving averages. So when we get this close to it, it's possible, but it would be rare that we don't test it. And particularly when we look at the SPY that has broken it, the QQQ that broke it and then tested it as resistance and then continued to make new lows, and the Russell, failing through that 50-day moving average all that pressure showing here on the market. Now, on that Russell here, kind of an interesting situation. When we start getting close to the 200-day moving average, you can sometimes see that 200-day moving average work exactly the way as the 50 does when we're getting close to it. It can just kind of engage almost as a magnet to draw the price down into it. One of my favorite shorting patterns of all time, though, is when we rally back to the 50 and then fail to the 200. Okay, very common pattern. It's the absolute reverse of the rounded bottom breakout. It's the blue ice failure. And you can take a look at a stock like DKNG, and you can see that possibility that could be occurring in here. You can see when we look at like Apple breaking below its 50, it didn't even have enough energy to come back to the 50. It just consolidated and now it's continuing to fall. But you'll notice in here all of our short-term averages crossing down. The reason I'm bringing that up is if you use a group of moving averages, it adds weight to another. So for example, with all of our short-term moving averages crossing down here, that creates not only we've got price resistance here in this chart, but it creates a technical level of resistance. Because if we rally back up and these continue to roll themselves to the downside, as this 50 is starting to roll over, somewhere over in here we may rally back and find that lower high in the market where we continue to sell. Not saying that will happen, just saying that does happen over and over and over in the market. And the same thing is true on bottoms and lows. You know, let's take for example, let's use like the diamonds here and go to a real short-term chart using these averages. If I were to go to maybe a 5-minute chart, notice right in here on the diamonds 5-minute chart, well, we're trying to do the opposite. On the shorter term chart, we're coming up and we're working to test this downtrend on that 5-minute, and notice there's that 50-day moving average. It's a 55-minute period moving average, but the same thing is going to be true here. When we start turning over in charts, we will have the same kind of patterns where we fail through these moving averages, rally back to test them, and fail. Happens over and over and over again on every time frame in the market. So very simple reading of moving averages tells us that even now, when we would like to see that relief rally here in the market, we're still struggling with this downtrend. We haven't been able to break through there. So how does that change? It changes the same way as it always changes. When we cross back through and break a downtrend in a chart, we will always create a higher low. That's how we know. See the gap up this morning? I was showing folks in RWO on a 15-minute chart. This gap up this morning where we just challenged the downtrend, folks that rushed in thinking, oh, we have to be going right back to the top now, got hurt this morning by buying because then we sold off and we made new lows. And we may not be done here in the chart. These simple moving averages will give you really good clues if you're willing to look at them in the chart. Now, the price action itself gave us the clues. If I take this just to my naked chart on a 15-minute, and one of my favorite indicators of all times is trend, support, resistance. Those are my favorite indicators when it comes to finding trades in a chart. Because every chart respects these simple rules of trading. Every chart. We'll eventually, there'll be times when we'll ignore those on a specific chart, but it's rare. But we'll always return to that. Just very, very simple price action trading, and this is your best indicator is price. Okay? Now, the way I trade, and you guys know the way I trade is very, very simple. I repeat the same things over and over and over, the same trades essentially over and over and over. If I don't get good quality patterns, I don't trade it. I have learned over time that I don't have to trade every day to be successful. In fact, I find that when I push myself that I have to actively trade, even when the market's not giving me great signals on those internals, on things like that, well, then I just increase my losses. It makes it harder for me to actually recover when the market is right, and I end up making less money by trading more. By pulling back on that trading when the market is not setting up like it should be setting up, when the trends and the internals aren't really there, I want to back off and protect my capital and wait for the better trades. Wait for that better setup that gives me a proper entry into a trade. And you can see that in the way I trade, because I've got a chart here and I've got this set up. I call this my ringer chart. And all this is the 3 exponential, the 8 exponential, and the 17 EMA, or I call it the trendinator. Rick calls it the trendicator. But it's basically a 17 exponential moving average. Okay. Technically speaking, when I'm looking at the diamonds, this diamonds chart on the daily, I want you to notice in this rally in here where we just extended to the upside, there was really no stopping. There was no support put in under this chart. When you see a chart extend away, you have to expect when the selling does come in, we can extend back down, because there really is nothing in price action holding that chart. But to be technically correct on a trade, I have to see that chart showing me the good signals where our 3 stays above the 8 stays above the 17. That's showing me trend. If the 3 crosses down through the 8, that's not a reason to buy. That means the momentum of the market is to the downside. The only way that becomes a bullish signal again is that comes back up and proves to hold. Okay? We need to see those downtrends breaking and these moving averages getting on the right side of each other. Then we have a trade. Let me show you something like Home Depot here. Can you guys see how this pattern right in here can give me confidence to maybe be long? It's the same pattern that occurred here. When we get these resting periods in stocks, rest over toward the trend, there's usually entry setting up in there, and I don't even need price to see that. Just simple averages here putting me on the right side of the trade. Okay, and those are really my favorite tools. Just something that's very, very simple. I want to remove that complexity from it. I want to read the price action of the chart. Not, I get questions about all kinds of indicators all the time. You know, people love stochastics. That's fine if you like stochastics. Then if you use it consistently, it will work for you. If you don't use it consistently, you're going to find all kinds of problems with stochastics. How many in here use stochastics and found out when it shows that you're overbought and you skip a trade, the trade just keeps going higher? Or you're oversold and you skip a trade and then it just keeps going down. There's a lot of false signals and indicators. And that's why I really don't use them. The false signals and indicators are pretty easy to understand too, because all indicators are calculated on basically 3 inputs. And that is price movement, time passing, and volume. So what that means is they're all behind the price action. They're all late. There's no other way that they can be. They're always late. Price has to already move, time has to already pass, and volume has to already be recorded before the indicator can be calculated, which means you're already behind the curve. Okay? So by looking at price action, I get better information and just having some simple indicators to help me see trend. Okay? If I'm confused about a position, if I'm confused about where things are going, I can find that really easily by just following trend. I used this little TC2000 sort over here is nothing more than stocks in this entire list. Okay, I can sort by that, and all it is stocks holding a 20-day trend on a 34 exponential moving average. Very slow. 34 holding a trend. That's all I care about. Because when I find a trend, then all I want to do is wait for the next entry into the trade. Okay? So when we see something trending up and you look at my charts, you'll see where I literally place price alerts. I want a stock near price trend and near price support for my trades. I want the market conditions to be showing me a favorable condition to be even looking long. And then I set alerts and wait for the trade. Now by doing that, let me tell you the big difference in this. What I used to do, and I think what most people do in the market, is they use indicators trying to predict the next move. So things like moving average crossovers and all of those different things in here. Well, for that to occur, this trade, by the time you enter this position, you're going to be up here. You're chasing that white candle. By seeing that pattern setting up ahead of time, I place an alert, and I'm going to consider that to be one of my favorite indicators as well, is the price action alerts. Because once I place the alert, I don't have to worry about this chart again. I don't have to think about it again. The alert is there. If the trade triggers, I know about it. And I'm going to catch that trade with a lower risk entry because I did that. I don't have to risk as much on a trade. I can even take the time to go say, well, does Mosaic have good options? Where would I want to be? The bid-ask spread's good. Is there enough open interest in there? I can do that ahead of time to even decide, well, maybe I don't want this trade. Okay. So let's talk just really quickly about price action, because I'm going to run out of time here really quick, which again is my favorite tool for trading. The 3-8 trap class that I teach is really, I hear people try to talk about the 3-8 trap and tell people that it's only about trapping the price between the 3 and the 8. To me, that's not the reason for the 3-8 trap. I've never ever taught it that way. That's not the purpose of the 3-8 trap to me. The 3-8 trap is to show me quality of price action. When we cross up, think about if this makes sense to you guys. When price crosses above those moving averages, we get above the trendinator, and we rest, consolidate, or pull back in a chart, but that 3 cannot go below the 8 before the buyers step up here, that shows me quality of trend. Momentum. Does that make sense? Are the odds of me winning on that trade better or worse if the 3 crosses below the 8 and then tries to cross back up? That shows me dysfunctional momentum in the market, volatility, and usually something I want to avoid. So what you can see here in price action, all I'm trying to do is follow the chart. Okay? And trends are very easy to find and very easy to determine, because all you need to do is find a chart that's trending either up or down. And there's the two functions that always determine whether trend is up or trend is down. And that is the trend has been broken. Break the downtrend, we hold a higher low. That's the beginning of the uptrend. It will be that way till the end of time. Okay, if it cannot hold the higher low, we sink back down. Case in point, that diamonds chart this morning that I showed you on the 15-minute. We gapped up with all that energy, never held a higher low. Trend consequently continues to move lower. Okay, on the 15-minute. We must break the downtrend and hold the higher low before we can assume any uptrend or trade any uptrend that move. Okay, and the thing is, guys, it can't be anything else. It has to be that. Okay, that's the only way trends are made. It's the only way they will ever be shown. You have to break downtrends and hold the higher low. It'll be the same every time you look at a chart. When you look at stocks that begin downtrends, it's always the same as well. We create lower highs and take out the supports, and now we are in a downtrend. Okay? It cannot happen any other way. Okay? So if you want to be long, look for long trending charts. If the chart is not performing, the 3 crosses down through the 8, then try to avoid that trade, because of those trades, my stats for all of these years will tell you that the 3 crosses down below the 8 and crosses right back up right in here, these trades will lose 50% of the time. Half the time they're going to lose. They cross up and don't hold. Cross up, don't hold. Cross up, don't hold. We have to have the hold. Cross up and hold, you'll have a winning trade. Cross up and hold, you'll have a winning trade. Cross up and hold, you'll have a winning trade. Okay, these trades, even with that much assurance, all of these won here, only about 70% of those are going to win. But 70 is better than 50%. Okay? It doesn't take a rocket scientist to figure that out. And it works on everything. You know, Scotty learned to trade the futures chart, the 333 tick futures chart, by watching what I do and trading the 3-8 trap in the futures. Very, very fast chart. It works exactly the same. Okay? When we cross down and we hold the resistance, we have a short. Not until. Notice this cross up just went straight up, no hold, goes back short. Okay? So if you utilize price action as your most important tool, your most important indicator, I believe you'll do better in your trading. And then if you add in those market conditions, what's going on in the market? Why should you be thinking long? Why should you be thinking short? Or should you be reversing that, be thinking about taking some profits, or maybe thinking about short positions because of those market conditions? Does that make sense? Now, I left here a couple of minutes for questions. You guys have any questions on any of this stuff? You've kind of heard, the purpose that I do the morning prep for. I put it out there for everybody now, but the morning prep is as much for me as it is for anybody else. It's for me to measure the market condition so I know that I'm working on the right side of the market. Do I ever use divergences? Very few, because you will sometimes see a major diversion in price and volume or something like that that's significant. But probably more is a term that I use as amplitude, Sandy. And let's see if this makes any, because it really is kind of a divergence, but I call it amplitude. When a move in the stock moves up so sharply and we stretch away from our moving averages, we stretch away from our trend, okay, that amplitude stretching away tells me that we're too far away from our major trend. And that gives me the signal here, hey, we just got a little bit carried away here. We're probably going to pull back. Now, it's the same kind of thing that Rick uses in his rounded bottom breakout. When we look at a stock that is in a rounded bottom breakout pattern, we look at that stock where we just went stretched too far to the downside. Everything got overextended on that down move, and we kind of diverged away from the trend. Does that make sense? Not so much the divergence in indicators or anything like that. It's divergence from the trend. Divergence where we're too far separated, because then I look for the pullback to occur on those moves. Trends are very, very important to me. I've been mentioning Google in here. If you take a look at Google in the chart, I'm going to go to. If you take a look at Google in this chart, this rest that's happening in here should not have been a surprise. This is still a very bullish chart. You could draw a trend up through here. You get more touches if you draw it up through there. You could draw it out here, and you can see you don't have very many touches there. So I would favor this trend here. And you can see all that Google is doing is what it's done every other time. When it stretches or diverges away from that trend, we spend a lot of time coming back to the trend. Kind of distance is alerting. 1 or 2 standard. I don't use any standard deviations, Sandy. I use the price. I want the lowest risk entries I can find, and I determine that by how far my stop loss is away. If I'm looking at a chart like here, you can see this consolidation that occurred right in here. I placed my alert over the top of that, because I can calculate this and saying, if the buyers step up above here, this consolidation that's off support and moving toward the trend here, I can calculate from my entry to my stop loss and say that's an acceptable risk or not. It has nothing to do with standard deviations. Okay, it's price based, how much I can risk on a trade. Okay, and I think everyone would serve themselves way better if they did just a little bit more planning in their trading, not just shooting from the hip. There's a major problem with a lot of traders right now where it's ready, shoot, aim. Take the time to aim first. You're going to hit your target more often. So think about where you want to be in the trade and where your stop is, and make that decision first off that either this is acceptable or it's not. Okay? If that's not a risk you're willing to take, then don't take the trade. If I can find patterns that are even tighter than that, those are the trades I want. Take a look at GE. Okay? We get these nice little tight consolidations that occur. This one right here, of all of this in here, this would have been my favorite trade right there. Just that one. Because I can place a price alert right here, set a stop loss here. We're following that trend to the upside. That's a low risk entry trade. I don't need a lot of those to make a lot of money in the market. I don't have to trade every day to find those. I just need a few good quality trades. And I can make a lot of money in the market without having to risk a lot if I'm patient. That makes sense? So I want to give you guys some time to take a break here. I'll break this off. Thanks for the question, Sandy. Hope you guys got something out of this. No big surprise that I'm not a super fan of indicators. I keep it really simple on that, and hopefully you picked up something in there in remembering to do that little bit of work to evaluate the market condition. That helps set your focus for the trade day. What's the market condition? Should I be worried about hurrying up and buying long? Should I be worried about taking profits? Because that can help you an awful lot in your trading. Where are we in the overall condition? So thanks for listening, guys. Hope you got something out of that. You're welcome. You guys have a great afternoon. John will be up here in a bit. I want to wish you all the very, very best. RWO, I will see you over there in the room before the end of the day. I'm going to be breaking away to do some coaching. Y'all take care and have a great one. Thanks, everyone.